Interest rates high. The U.S. Central Bank on Wednesday raised loan costs by 75 basis points, or 3/4 of a percentage point. It is the greatest interest hike in 28 years and is part of the strategy drawn out to control the ever-increasing inflation that has bothered the economy and markets, starting from stocks and bonds to cryptocurrency. The U.S. Federal Reserve likewise reported it would keep decreasing the size of its accounting report at the rate declared in May as per an assertion by the Federal Open Market Committee (FOMC), which sets the Fed's financial strategy. The Fed funds rate, the scale at which businesses and banks can get and loan their overabundant stores to one another on a short-term basis, will ascend to a percentage of 1.5% to 1.75% as per the Fed. Bond bankers are estimating in a scope of 3.25% to 3.5% before the year's over, suggesting a surprisingly quick and unforgiving speed of financial fixing, as per Goldman Sachs. The current picture is plain to see. The labor market is extremely tight and inflation is much too high, reported by Federal Reserve Chair Jerome Powell on Wednesday at a press conference after the decision was announced. The last time the Fed raised its benchmark rate by a 0.75 of a rate point was in 1994. Powell said the U.S. National Bank won't pronounce triumph until authorities see unquestionable proof that expansion is descending. Considering that May's Consumer Price Index estimating inflation came in more smoking than anticipated at a new four-decade high, markets at once began responding to the chance of a quicker rate hike in the days paving the way to the current week's Fed meeting. The closed entryway meeting began on Tuesday and finished with the assertion on Wednesday at 2 p.m. Eastern. Now, markets loathe uncertainty and unpredictability. A decrease in downward volatility will only likely be achieved with a pause or reversal of the current Fed policy and direction, said Josh Olszewicz, head of research at Valkyrie. Bitcoin BTC was switching hands up to $21,444 after an hour after the meeting, up from $21,076 when the decision was delivered. Most experts had proactively evaluated the increase in the days before the meeting. According to the statement released on Wednesday, Fed claimed that overall economic activity appears to have picked up after edging down in the first quarter. Job gains have been robust in recent months and the unemployment rate has remain low. Inflation remains elevated, reflecting supply and demand imbalances related to the coronavirus pandemic, higher energy prices, and broader price pressures. Fed dot plot. During his public interview in May, Powell had precluded the chance of a 75 premise point climb, saying that it's not something that the council is effectively considering. Instead, national brokers had indicated 250 premise point hikes in June and July. However, the circumstance changed after the last Consumer Price Index report showed a speed increase in inflation to 8.6% as opposed to a decrease which was expected. Powell had referenced at his late conference that on the off chance that the Fed didn't see inflation pressures subsiding and descending, the national bank would think about moving more forcefully. Powell said Wednesday that last week's inflation shock demanded serious areas of strength for justification at this meeting, instead of sitting tight an additional month and a half for the following social event. Powell revealed that we decided we needed to go ahead, and so we did. He came to the view that we'd like to do a little more front-end loading on that. Along with the statement, the Fed distributed updated quarterly financial projections, or dot plot, a pictorial portrayal of Fed authorities' projections for the national bank's key momentary loan fee. Individuals anticipate that the assets rate could increase to 3.4% in 2022 and 3.8% in 2023. Effects of the interest hike. The federal funds impact the government finances rate to control inflation. By expanding the government support rate, the Federal Reserve is successfully endeavoring to recoil the stockpile of cash accessible for making more purchases. This makes cash more hard to obtain. Alternately, when the Federal Reserve diminishes the government finances rate, it expands the cash supply. This energizes spending by making it less expensive to obtain. The national banks of different nations follow comparative examples. The increase in rates also affects spending in a way. With each credit, there is some likelihood that the borrower won't reimburse the cash. To repay banks for that loan, there should be a penalty. Interest. Interest is the amount of cash that banks procure when they make a credit that the borrower reimburses, and the interest percentage is the level of the credit sum that the lender charges to loan cash. The presence of interest permits borrowers to make use of the cash right away, rather than standing by to set aside the cash to make a purchase. The lower the interest rate, the more willing the individuals are to make huge purchases like houses or vehicles. At the point when buyers pay less in interest, this gives them more cash to spend, which can gradually increase the buying power all through the economy. Companies and farmers additionally benefit from lower interest fees, as it urges them to make enormous gear buys because of the minimal expense. This yields a better output and increases efficiency. Well, that's it for today's video, guys. We believe this information was valuable to you. We appreciate your trust in our research. Please do give a like to this video. Also, comment down and tell us what you would like to hear more from us. We'll appreciate your feedback and suggestions. And if you're new to the channel, don't forget to subscribe to the channel, and we'll see you soon in the following video. Stay tuned and connected.